Imagine this. The next crisis hits tomorrow. Stocks crash 50%. Bonds get torched. Your neighbor loses everything, but you barely flinch. In fact, you wake up richer. Not because you predicted the crash, but because you own the only 3 positions that have survived every single meltdown for the last 100 years. The same 3 that turned the Great Depression into a buying spree, that made millionaires in the 1970s while everyone else went broke, that let investors buy Apple and Amazon at fire sale prices in 2008 and 2020. Warren Buffett just parked a record $325 billion into position #1. Central banks are panic buying position #2 faster than any time since World War II. In the next 10 minutes, I'm going to show you exactly what these 3 unbreakable positions are, and why, right now, in 2025, the smartest money on the planet is piling in before the next shoe drops. Don't move. Here are the 3 positions that have never failed in a century of chaos. Position 1. Cash and short-term treasury bills. Position 2. Physical gold or allocated gold. ETFs. Position 3. The S&P 500 index. That's it. Nothing exotic. Nothing you need a hedge fund passport for. Yet these 3 have survived every crisis on record. Let me show you how they performed in the 5 worst disasters most investors have ever seen. The Great Depression to 89% stock crash, cash and T-bills gained 30% real return while prices collapsed. Gold was fixed until 1934. Then Roosevelt revalued it from $20.67 to $35 overnight, a 69% instant gain. The stock market took 25 years to recover. But if you simply held the broad market with dividends reinvested, you were back to even by 1945 and up 5 by 1960. The 1970s, stagflation, inflation, 7 to 13% a year. Long bonds lost 50% in real terms. T-bills rolled and adjusted, eventually paying 15% and preserving capital. Gold went from $35 to $850, a 24 explosion. Stocks went sideways for 14 years, but still paid 5 to 6% dividends. Then, from 1982, the greatest bull market in history began. 2008 financial crisis cash was oxygen when the system froze. Buffett's $40 billion cash pile let him buy Goldman Sachs and Bank of America on terms that made him tens of billions. Gold fell at first for liquidity, then tripled as the Fed printed. The S&P dropped 57%, but from the March 2009 low it delivered 400% returns in the next decade. COVID 2020, fastest crash ever, 35% in 23 days. Cash let legends like Bill Ackman turn $27 million into $2.6 billion in weeks, then buy the dip. Gold dipped briefly, then hit all-time highs as $6 trillion in stimulus was printed. The S&P recovered everything in 5 months and then doubled again. 2022 bear market rate hike. Massacre T-bills went from 0% to 5% and became the best performing asset class of the year. Gold held its value while bonds got obliterated. The S&P fell 18%, but anyone who just held captured the 26% rebound in 2023. Same 3 assets, different crises, different decades. Always one of them shines, the other to preserve, and together you never get wiped out. Why do these 3 work every single time? Cash T-bills give you optionality, the ability to buy when blood is in the streets. Buffett calls cash a call option on every asset class with no expiration date and no strike price. Gold is the only financial asset with 5,000 years of history that has never gone to zero. When governments print money to solve their problems, gold is the antidote. The S&P 500 is ownership of the most innovative economy in history. Over any 15-year period, it has never lost money. 10% compounded for a century. Right now, in 2025, the pattern is screaming louder than ever. Warren Buffett is sitting on $325 billion in cash and T-bills, to 30% of Berkshire Hathaway, the largest cash position in the company's 60-year history. He's been selling Apple, selling Bank of America, and saying publicly he can't find anything fairly priced. Translation: he's waiting for the crash. Central banks bought over 1,000 tons of gold for 3 straight years, the fastest pace since the gold standard ended. China, Russia, India, Poland, Turkey, they're all dumping US treasuries and stacking gold because they see $36 trillion in US debt and know what comes next. And the S&P 500. Long-term giants like Buffett, Dalio, university endowments, they're not selling their core holdings. They're just refusing to buy more at these valuations. They know time in the market beats timing the market. So here's the simple allocation the pattern gives us in 2025, under 40 years old. 20% cash, T-bills dry powder, 10% gold, insurance, 70% S&P 500, maximum growth 40 to 60 years old, 30% cash, T-bills, 10% gold, 60% S&P 500, over 60, 40% cash, T-bills, 10% gold, 50% S&P 500. How to own them today: cash, T-bills, brokerage, sweep or money market funds, yielding 4 to 5% with zero risk. Gold, physical coins, bars or GLDIAU. Make sure it's allocated, not paper promises. S&P 500 symbol, SPY or SPLG. Set it and forget it. Dollar cost average every month. This is not sexy. It will never go viral on TikTok. It won't make you rich next quarter. But it will make you rich over the next decade. And it will make sure you are still rich after the next crisis, whatever it is. Most people will ignore this. They'll keep chasing 100 memes and concentrated bets. When the crash comes, they'll panic sell at the bottom and learn the pattern the hard way. A tiny minority will see this video, quietly rebalance to these 3 positions. And when the storm hits, they'll be the ones buying while everyone else is crying. The pattern has spoken for 100 years. The smart money is already positioned. The only question left is, which side of history will you be on? This is not financial advice. It's pattern recognition. 5 crises, 3 positions, a century of proof. Position yourself accordingly.